This video I'm going to go over how I use the Fibonacci retracement tool. This tool is very subjective, so you're gonna find that people probably draw this differently. But like I said before, in trading, the traders should define their own rules, follow their own strategy, and backtest and ensure that they have confidence in what it is that they're using. So I've backtested this. I have much confidence in the way I use it. And since you follow my strategy, or my rules at least, until you develop your own rules from having experience in the market, this is how I draw my Fibonacci retracement tool lines. So first off, I'm going to start by showing you my levels on how my levels of my Fibonacci retracement tool. So I'm just put it on, right? I'm just put it on there, and I'm gonna go to, where is it? Just click here, settings. So those are the lines that I use, or the levels that I use. I advise you to take a picture of these. It's the ones that are checked, obviously. I advise you to take a picture of these, screenshot these, and implement them on your chart. Okay, so first off, I'm going to explain what exactly Fibonacci is. Fibonacci is a bunch of ratios that people believe are not mythical, but they can find these ratios throughout many instances in life, and somebody thought of a great idea to apply it to trading. And long story short, what we use it for in trading is to measure the retracement of an impulsive move, right? So as we can see on the 1 hour, we had a impulsive move from the downside to the upside. So we saw a price moved up, and then if you came here, you saw a price retrace here, right? So what you would use the retracement tool for is, as you can see what I have it for here, it is measuring this retracement right here, and then it continued up, right? The way I draw my retracement tool or Fibonacci on my chart is I would put it at points in let's say we're in an uptrend. I would put it at points where price found support, which would be right here, which would be the first bullish candle after a bearish candle, to where price found resistance, which is right here, which would be the last bullish candle after the move turned down. So here's an example of that. Like I said, some people draw their one differently. Some people, they put it to the lowest wick to the highest wick. But I think it makes more sense to do it from where price found support to where price found resistance, right? So I'll circle it to highlight what I mean. Right here, you can see price found support indicated by this bearish candle, and then the first candle, the next bullish candle, price went away from the area, and then vice versa. You can see it here, price found resistance because it's the last bullish candle, and then price fell down from here. So to me, this would be my point A, this would be my point B, right? And as you can see, now that you know how to draw it, now you're probably wondering, what do these numbers mean, right? So on here is a list of numbers that mean the most, which I would say are your golden ratios, and they are the 38.2, which is right here, 38.2%. The 50%, it's okay because it shows that price has retraced 50% of the move. But another golden ratio is the 61.8%, the 78.6%, and the 88.6% in some cases, right? So with these levels, usually if price come 23.6% right here is in this area, we usually would find that price consolidates or just move sideways and then either go up or continue to fall down more, right? And if you see price would consolidate in this area between 0% and 23.6%, then you know that is a pretty strong trend. I'll just put it here so you can see the numbers better. Let's see if I can find a clearer one. This is another example of me drawing it here. Price found support here, price found resistance here. So as you can see, price consolidated within this area and then fell down and then came near the 38.2%. Now I usually go off, I'm a type of trader that goes off of candle closes or where the body stops. Yeah, I respect wicks, but I like full body stops, and that tells me where I use that to indicate my lows, my highs, and so forth, right? So I also do that here for my Fibonacci retracement levels. So This price, you can see it came between this zone, which is between the 23.6 and the 30.2 zone, and I'm happy that happened because not everything is going to be perfect, but as you can see, price still respected this area now, and this would be like a great confluence area, an example of confluence, because this right there technically is a supply zone. Also, as we can see, it's a 4-hour resistance, broken resistance, turn support area, and then it's confluence with the 23.6, or it's close to the 30.2 resistance area. So all these are, and then we have price action making bullish candle price. So all these are signs or confluenced that price will start to continue upwards now. Also, something to bear in mind when using Fibonacci, or the levels that I'm giving you on my Fibonacci lines, these here are your last areas right here, the 110% and 120%. These are your last areas of, if you have nowhere to put your stop loss, these are your last area. Let's say you took an entry off the 23.6, it's your last areas of stop, right? And vice versa, when you want to set your TP, we set our TPs at the negative 27% right here, and actually that's first take profit, and second take profits are at the negative 61.8%. Okay, so yeah, if you have nowhere to put your, I'm going to go over more areas and ways I take my take profits and stop losses, but you can also use the Fibonacci tool to give you a stop loss or take profit as well. And I'm glad I mentioned that, because now I want to explain why the 23.6 area is one of the most dangerous areas on this Fibonacci retracement tool. And it's simply because price can literally, we in a bullish trend. So what we broke these highs here, now we put in a higher high, right? And as we know, a trend consists of an uptrend, because we're in an uptrend. It consists of higher highs and higher lows, right? So this right here is your higher high. You can see prices going up. This is a higher high. This is a higher low, right? Higher high. Now for this market to continue upwards, we need price to find support to give us a higher low to possibly make another higher high, right? Now the thing about that is, right, as we know for our trends, this area right here, yes, price not terminated, but found support in this area between 23.6 and 30.2% area. Price could have literally come all the way down. It could have came to the 50%. Price could have come down to the 50% level, continue up. Let me put these in a brighter color or a different color so you can see them clearly. Put them in blue. Blue. Price could have did something like that. Price could have come down to the 61.8 and then continued up. Price could have come down to the 78.6 and then continued up. And this goes for the same for all the way up until the 88.6 and 100%. Even 88.6 and 100%, right? So when price starts to break this area, your last area of support or safety is these areas here, right? But technically, if you have price coming below the 100%, then we have a structure break, because now price is testing the previous lower high or higher low, which would be right here, right? And as we say in trends, if an uptrend to continue, you need higher lows and higher highs, right? So if we're breaking the previous higher low, then we're essentially putting in a lower low, right? So that means it's like trend changing behavior, something you want to watch out for, which is why these areas here are your last areas of safety for your stop loss, right? So back to why the 23.6 area is dangerous, and it's simply because, like I'm saying, is price can literally come all the way down here and still be a buy, right? because it can come all the way down here and put in a higher. We just want price to put in a higher low to continue upwards. Okay, so essentially that's where risk management comes into play. So if you in an area like this and you support your stop losses down here, you may want to take a smaller lot size, right? As opposed to, let's say if price was to come down to 78.6 or the 88.6 area, and our stop losses is below the 100% or 110%, we can essentially take advantage of a higher lot size play simply because we are now you have a smaller stop loss, which means you have less mess up room for price to go in the next direction. You have from here, you can see now that price is so close to breaking this previous higher low that if price was to break here, you can easily get out, right? Now, if you up here and you let price come all the way down here, one, you should have been closed and just wait for price to show you signs of bullish actions. But if you did try to hold, this is a lot of drawdown to put on your account, okay? And if you have a higher lot size, that's a lot of stress and pressure on a trader to prematurely exit and so forth, right? And lose on something that you didn't have to lose on. So that's why we always try to get really good entries, and or we usually like to take our trades after price has give us valid signs that is ready to continue in the previous direction or continue in the market direction. And yeah, that's how you use Fibonacci lines. Stay tuned for the next lesson.
Yeah. Yeah.